Hey everyone, welcome to this explainer. Today, we're rolling up our sleeves and really unpacking IFRS 15, Revenue from Contracts with Customers. This standard literally overhauled how we recognize the top line on the income statement. It shifted the whole focus right over to the transfer of control. So, let's break down how this actually works in practice.
So what's the ultimate goal here? It's all about reporting useful, crystal clear information about your revenue and cash flows. And the core operating engine, the beating heart of this entire standard, is this single idea. You recognize revenue to depict the actual transfer of promised goods or services to your customers for an amount that reflects what you expect to get in exchange. It is no longer just about that old risks and rewards model we used to rely on.
All right, here's our roadmap for today. We're going to hit the scope and objective, the recognition criteria and steps, initial and subsequent measurement, contract costs and disclosures, professional judgment and errors, and finally, exceptions and interactions. Let's get right into it.
Section 1. Scope and objective.
Okay, first things first, we have to know exactly when we even apply this standard. IFRS 15 applies strictly to contracts with customers. And by customer, we mean a party that has specifically contracted with you to obtain goods or services that are an actual output of your ordinary activities. Now, if you're doing a non-monetary swap with a competitor just to facilitate sales, say two oil companies swapping oil just to meet local demand, that is explicitly out of scope. Also completely out of scope are leases, insurance contracts, and financial instruments. They have their own dedicated standards, so we leave them out of this completely.
Section 2. Recognition criteria and steps.
So here's the absolute step-by-step workflow for IFRS 15. It's a 5-step model, and you simply cannot skip a step. You identify the contract, you break it down into performance obligations, you figure out the total transaction price, you allocate that price across the obligations, and finally, the best part, you recognize revenue as you actually satisfy each one.
Now, step 1 has a very strict gateway. You recognize a contract only when absolutely all of the following criteria are met. 1. The parties have officially approved the contract and are committed to it. 2. You can clearly identify each party's rights. 3. The payment terms are identifiable. 4. The contract actually has commercial substance. And 5. Collection of the money is probable. So if all those criteria are met, then you go ahead and account for the contract. But if they are not met, then you do not have a contract under IFRS 15 yet, and any cash you've already received must be recognized as a liability until those criteria are met or the deal is terminated non-refundably.
Let's pause and define a really crucial term of art here, the performance obligation. This is the concept that dictates exactly how we break down a contract into distinct accounting units. A good or service is considered distinct if the customer can actually benefit from it on its own, and if your promise to transfer it is separately identifiable from the other promises floating around in the contract.
Now, we all know things change during a contract, right? So let's use some clear conditional logic for modifications. If a modification adds distinct goods at their true standalone selling prices, then it's easy. You account for it as an entirely separate new contract. Simple. But if it doesn't meet that bar, you really have to look at the remaining goods. If the remaining goods are distinct, then you treat it as if the old contract was terminated and a brand new one was created. If they aren't distinct, then it just forms part of the existing obligation and you have to do a cumulative catch-up adjustment to your revenue.
Section 3. Initial and subsequent measurement.
All right, let's talk numbers. The measurement basis here is the transaction price. That's just the amount you actually expect to be entitled to in exchange for transferring the goods. Included in this price are your fixed amounts, variable consideration, non-cash consideration, and any significant financing components. Excluded, however, are amounts you collect on behalf of third parties, like sales tax. That money is just passing through your hands. To put this into a concrete transaction example, imagine you sell a commercial server for a fixed $100,000, but the contract includes a $10,000 bonus if you finish the installation a week early. That bonus is variable consideration. It must be estimated and included in your transaction price up front, provided it's highly probable you won't have to reverse it later.
Okay, so what happens later? We really need to map the exact flow of subsequent changes directly to the financial statements. If the transaction price changes post-inception, then you allocate that change on the exact same basis you used at contract inception. And where does it go? Straight to the P&L as revenue, or a reduction of revenue in the period of change. We also have to map out modifications. Depending on the situation, these modifications might result in prospective adjustments to your contract assets and liabilities directly on the statement of financial position, or they might hit the P&L immediately as a cumulative catch-up adjustment.
Now here's a massive practical expedient, a real policy choice you'll want to remember. Normally, if the timing of payments gives the customer or your entity a significant financing benefit, you have to adjust the transaction price. But the standard offers a great shortcut. If you expect the gap between delivery and payment to be 1 year or less, it produces the option for you to simply ignore the time value of money. This saves practitioners from having to run highly complex discount rate calculations on standard short-term trade receivables.
Section 4. Contract costs and disclosures.
We've got some strict criteria required to actually capitalize costs rather than just immediately expensing them. If costs are incremental to obtaining a contract, meaning, hey, you wouldn't have incurred this cost if you didn't win the deal, like a sales commission, and they are recoverable, then you recognize them as an asset. Now, for fulfillment costs, if they fulfill a contract, then you recognize an asset only if they relate directly to that specific contract, they enhance resources for future performance, and they are expected to be recovered. General administrative costs or wasted materials? Nope. Those must be expensed immediately.
Here is another absolutely critical policy choice that can save you a lot of headache. Say you pay a sales commission, but the contract is only for an 8-month period. You don't have to capitalize that commission and drag out the amortization over 8 months. If the amortization period of the asset would be 1 year or less, your entity can choose to just recognize those incremental costs as an immediate expense the second they are incurred.
When it comes to disclosures, the whole objective is to help users really understand the nature, amount, timing, and uncertainty of your revenue. You need to separate your quantitative disclosures, like disaggregating your revenue into useful categories and showing the opening and closing balances of contract assets and liabilities, from your qualitative disclosures, where you explain the significant judgments you made behind the scenes. Oh, and a quick condition to note: if you use a practical expedient, like that 1-year financing rule we just talked about, then you absolutely must explicitly disclose that fact.
Section 5. Professional judgment and errors.
We absolutely must flag a major area of estimation uncertainty here, and that's variable consideration. If a contract has bonuses, penalties, or discounts, you have to estimate the final price. But your estimates must be constrained. You can only recognize revenue to the extent it is highly probable that a significant reversal won't occur later down the line. This variability is usually driven by things completely outside your control, like market volatility, obsolescence, or situations where you just have a massive range of possible outcomes. The golden rule here: do not over-recognize revenue too early.
Let's look at a few frequent, real-world application errors. These are the traps people fall into all the time. A really common mistake is taking a non-refundable upfront setup fee and treating it as immediate revenue. The correct approach: you have to assess if a distinct service was actually transferred. Usually, setup activities aren't distinct at all, so you must defer that revenue over the life of the contract. Another mistake is updating your discount rate for a significant financing component just because market interest rates changed. The correct treatment is locking that rate in at contract inception and never updating it. Finally, do not try to capitalize wasted materials as a fulfillment asset. The correct treatment is recognizing those wasted materials right away as an immediate expense in the P&L.
Section 6. Exceptions and interactions.
You really want to pay close attention to these carve-outs. You apply IFRS 15, except when the contract is actually a lease. In that case, you must drop this standard and apply IFRS 16 instead. You generally treat a sale with a right of return as a regular sale with variable consideration unless the customer has a significant economic incentive to exercise a put option, forcing you to buy the asset back. If that happens, you have to treat it as a lease or a financing arrangement. And lastly, you shall not simply allocate a contract discount across all performance obligations if you have observable evidence that the discount actually belongs entirely to just one specific bundle of goods.
Let's tie this all together by seeing how IFRS 15 bumps into the rest of the accounting standards. IFRS 9 financial instruments is used right alongside IFRS 15. Specifically, you have to use IFRS 9's expected credit loss model to assess your IFRS 15 contract assets for impairment. Next, IS 37 on provisions takes precedence over IFRS 15 if a contract with a customer becomes onerous, which just means the unavoidable costs of fulfilling the contract have exceeded the economic benefits. And finally, IFRS 3 business combinations governs the initial measurement for contingent liabilities, but it defers right back to IFRS 15 principles when you're looking at the subsequent recognition of cumulative income.
We have covered a tremendous amount of ground today, from that strict 5-step model all the way to complex measurement and disclosure requirements. So I want to leave you with a provocative thought to help you critically evaluate your own organization's compliance. If the actual transfer of control is the absolute new core of revenue recognition, how much of your current revenue might still be incorrectly sitting there based on outdated risks and rewards thinking?
It's like a giant puzzle, and you really need to think about that as you review your active contracts. Thanks for joining me on this explainer, and I'll catch you next time.